So in the larger perspective of things, I would say with the extremity of this bubble that we have, we are at the final end, we are at the supercycle end here. We have been going in with liquidity to try to solve the solvency problems for so many years, and we've done it for 17 years. It's just creating a situation where the whole financial system needs to reset. And that is coming back to the Kondratieff setup there. That is actually what it suggests also. We are at that end. What is it that you need to be into, or what your assets do you need to hold in a reset like that?
Welcome to this very special interview. I'm, as you can see, with Henrik Zeberg. Actually, it's quite crazy because I just wrote you a few weeks ago, and I told you about what we're doing here, and about the fact that we invited a few thought leaders in finance, and that we wanted to record some content on all those topics, and share this beautiful house, like this massive villa with this gorgeous, I never get tired just watching like this landscape. And you said yes, and there you are. Just a few hours ago, a few days ago, you were still in Copenhagen. You flew all the way here, and we spent a few days. Yesterday we went on a helicopter ride. We had a wine tasting before that. We were driven by those cobras, and yes, it's an absolute pleasure to actually meet you in person, to have spent all the time together. And now we have some time to do like some one-on-one session, and to also get a bit more insights about the way you think, and the way you establish models, the way you see the markets. We're going to talk about your different methods. We're going to talk about also like some indicators, the housing market, the crypto market at the moment that is tanking hard, and obviously gold, which you've been really also bullish on a big macro scale. So first of all, thank you for being here.
Oh, thank you for inviting me.
Yeah.
Who would say no to this? Well,
yeah, and you are also a big thinker in terms of the Elliott Wave theory, which you told me just before is a more like long-term way of seeing at cycles. Why do you think it's a good model?
No, so I think so. Elliott Wave is a way where you take psychology into the markets. So as when we act as individuals, we have our own free will. We can decide whether we want to sell or buy gold, sell or buy Bitcoin now. We have free will. But if you look at it in a larger perspective, you will see, that's at least my thesis, you will see that patterns emerge as we come together as people, as we get into a crowd. The crowd dynamics is fascinating, I think. If you look at how people will get out of a burning house, you will see that there will be certain patterns. You can almost, you can simulate how how that will happen. And if you look at that, really a burning house can be a good analog or a good description of what you can see in the market sometime. So you will actually see that there will be some people understanding that the house is on fire and start getting out before that, and then there will be somebody understanding the trend a little later on, and then the massive the bulk of people will start to run, and then there will be latecomers and say, oh wow, we didn't see that, and it'll be there when the smoke is there still, right? So I think like in a burning house, you will see in the markets as well also that people will come in and out of the market in a way which is cannot be described 100%, but there are simply some beauty to it when we come together in a group. And if you can say, if you look at the markets, we're just doing massive amounts of trades every day as people, and we are being exposed to the same kind of information that comes from the media, from the macro indicators, and so on and so forth. So I like Elliott Wave from that because, and also if you look at technical analysts, they kind of often can see the shoulder head shoulder pattern, or these patterns that is recognized by a lot of people. But to think that there is only one or two or five patterns is kind of a a bit naive, I would say. So the way I went about it was really to say, I think that we actually can start study these patterns in a better way. And I didn't invent Elliott Wave. I was just a user of it, and or a student of it. So I would say that it's a thing you can use when you are doing it on a longer time frame, correct, as you also mentioned, because it's in the short time frame you can make a lot of mistakes. And I think people that are diving into 1 hours and 15 minutes charts and trying to do Elliott Waves doesn't work. But if you actually sit down, and this is part of my model also, that you base it, first of all, I have the foundation of it is a business cycle model, but on top of that, then you have the Elliott Wave model based on a multidimensional setup of markets, so commodities, bonds, equities, and everything else. And you kind of see the larger patterns in those and align those with the normal understanding we have of the economy. Then there is a beauty coming out of it, at least as I see it. So when you look at that, that's why you, in a longer time frame, you can be bullish for longer. For instance, now I still say I don't think we have seen the final end of this market, the bull market here, because there's simply more upside in it in my Elliott Wave model, and it's confirmed by a lot of other the markets in the multidimensional model that I think there is still some time to go. The yield still needs to decline, and there are other signs that we need to see. So this is why I like Elliott Wave. So people are misusing Elliott Wave, on a grand scale. So it means that if you go to Twitter, you'll see 99% of the time, you'll see that the patterns that are coming up there is just, a guesswork of what comes within the next 1 to 4 hours or something like that. And obviously, it's more difficult to make a correct chart. You can be lucky, of course, if you are using that kind of approach, but if you do it more on a larger scale and a multidimensional approach, then it's you have a larger likelihood of making something that can work.
So actually, because I think it's important as well to maybe describe how the Elliott Wave theory would work and what are, let's say, the basic things to understand about it, and also maybe with an example of the past.
Sure. So you can say that, again, you cannot just let Elliott Wave work, just say, so we start with one particular market and say, now I want to do it on that. That approach doesn't work. So the way I think you need to go about that and understand the structures in the market is, first of all, you need to understand the macroeconomic situation. So the business cycles, where are we? So if an example was, again, why did I call a market rally and a bull market in 22 when it started there in October? Well, it was because you could see that the business cycle was telling me we are not in a situation where we are falling into a recession, and time has proven me right on that. And I said also we would see a market rally because when your business cycle is telling you this is not the end of it, this is actually the beginning of it. And you can then say the Elliott Wave will tell you, okay, how far can it then extend? Then you can start using some of the extension, the Fibonacci, which is an very integrated part of Elliott Waves to give you some indications of where you're going to go. Not so much when, and that's what people always want to know, but where. But if you have the direction correct, you can say, well, we're probably going to around 6,000 when we were 3,500, which is what I said. Well, then you have something of a direction that you can then work on. It doesn't mean that you'll get every dip correct, but it means that you will stay with the bull market, which is not too bad. And you will probably also, if you have the business cycle model, be able to get out when the time is due. So this is but this is just a part of what I do. I mean, the whole thing is really of understanding the way the economy works, because that and then attaching that to the market is really where I think the magic comes out. If it's magic, but at least as I see it, right?
Yeah, and so you just mentioned like how the economy works. What are your frameworks on that part? You mentioned the business cycle as well.
Yeah, so there are people talking about the business cycles, and there are various ways of looking at that. I actually use a setup which is also where the data comes from what is called the conference board. There's also data that you can just go get on the internet. So it's data on leading indicators for the economy, coincident indicators, and lagging indicators. And then I look at it on a monthly basis, but my model that is really the one that tells me whether we're going to get a recession or not is on a quarterly basis. And there you'll have that the leading indicators, which are some parameters that you can follow, one of them is the yield spread, for instance. So the 10-year minus the Fed fund rate is to be quite exact. is telling us that, okay, what is ahead of for us? And then you will have the coincident indicators, which are more related to the labor market and to also the housing market, and to the production, which are the ones telling us what is it that we see right now. And then you will have lagging indicators, which are the ones that comes after. So what is it that we should then expect? So what is the leading indicator telling us? What should we then expect for the coincident? And what comes then next for the lagging? So it's like a sequencing of things. So, and when you understand that and you start to see, okay, I see this, now I need to sit and wait. Doesn't mean that things are now developing in the economy, but I need to sit and wait for things to start to develop. So specifically, there was a recession indicator or signal from the leading indicators in 23, late 23 actually. And then people say, well, you can't use that for anything. Well, actually you can't, because when the quarterly model tells me that we are rolling over, that means that we then have to start looking at the coincident indicators, which is the labor market. And then you'll have to wait to see until that rolls over. And then you'll wait to see what happens then in the lagging indicators. So it's really a waiting game. It's like what I'm trying to explain to people is it's a super tanker that's turning. And you can start to see, oh, now it's turning. But when has it turned 180 degrees and you're going the opposite direction? That is what we need to see. We need to have the different points and say, okay, now we see that, now we see that, now we're turning. So with that, excuse me, with that, you will then have a setup where the leading indicators will tell you, okay, something bad is coming. It's not here right now. It's not an imminent recession, but the ship has started to turn. Then you wait for it to see it in the labor market. And there you're looking at the initial claims, you're looking at also the unemployment rate, but you're also looking at factors like hours worked in manufacturing. So what is happening when the economy is slowing is that you'll see that businesses will start to cut the hours that is needed to work for the employees. Obviously, you don't want to lay people off immediately. So you'll start to see that there is a decline in that. You'll also be looking at something like the continuing jobless claims. So when jobless claims is not spiking like we see now, it's actually very low. But you'll see the continuing jobless claims is actually staying higher and moving up, and now it's been plateauing for a little while. But that is a signal that people was not able to find a new job. So they might not get fired immediately, but they don't find a new job. And then you move into other areas also of the labor market. You look into, obviously the non-farm payrolls, but that's just one number, and it's flawed also, and it'll be revised. It's been revised by 60, 70,000 per month on average over the last 5 years, if you go back and take the big revisions in. So you cannot just look at that and say, now this is a strong economy because you have that. So it's really about double clicking on the different parameters that you have, the coincident indicator, and waiting for that. Mm-hmm. And then people say, well, it's a wait, yeah, then you'll not be right. Well, actually, there are some very imminent signals that you can look for. And this is where you start to look to the yield markets. Because if there's one thing that will tell you whether the patient is sick or not, then it's the yields. And it's about understanding, again, in the bigger perspective, where are we then? Are we starting to see the deterioration? Do we get the signal in the leading? Do we have a deterioration in the labor market and in the other important market, which is the housing market? There are two important markets, housing market and labor market. And then looking at the yield saying, when is the trigger? So I haven't called for an imminent recession. I said a recession is coming, and it's going to be bad because of the big setup we have, because of the immense, the extreme bubble we have right now. But I haven't said it's an imminent recession. The imminent recession I will call the moment my imminent recession indicators are signaling that, which will be something about the short-term yields, and it'll be about the labor market also, where we look at the initial claims, which should be spiking up. So these are the things I'm waiting for now, because we are definitely seeing that there is a structural damage to the economy, which we see now in the housing market.
Mm. For the Elliott Wave theory, do you have like in your model? Do you see like the data on a per yearly basis, on a per decade basis? Like where do you see basically like because you said that people on a shorter time frame are getting it wrong.
Yeah.
What is the time frame that you need to look at? You said quarterly for the other parts of the business cycle. What would it be for the Elliott Wave?
No, so in order to get the understanding of where the economy is heading, and again, if you have the belief that we are actually living in a world where there are structures that are unfolding, then you'll have to go back a long time. So when I look at my model with the dollar, for instance, with the Dixie, it goes back 70 years. So, but that's to understand the big structure of it. Are we in a general bear market here? Are we in a correction in a bear market in a longer time frame? Where are we? And what we see right now for that is that the dollar, for instance, bottomed out in 2008 at the time when they introduced quantitative easing. Ironically enough, when they started to print money or expand the balance sheet, we saw the dollar strengthening, and we have seen that ever since. And we are actually, in that perspective, we are in a larger bull market move. And that bull market move will not stop before we see 120. Well, does that mean we go straight to 120 here? Because that's always what people say. Oh, so you're saying you're bullish the dollar right now? And say, no, I'm not. I'm actually bearish the dollar, because I think we first will see a decline in the dollar because there is a structure to it. So in that way, if you start to look at in the bigger perspective, you'll see that you can have a directional thing, and there is an ending point to that, which is around 120 to 122 on the dollar, which will have implications, because a dollar at those levels will be very deflationary. So that is how I do it, and then again align it across different markets. So it's not just based on one thing. So I'll not just be looking at the dollar and then say, okay, so if you have the dollar there, and obviously I need the support from the different components of the Dixie, which will be the euro dollar, it will be the pound versus the dollar, and the yen versus the dollar, and understanding their individual setups. So it's like you have the different markets, but it needs to be supported by different components there, because otherwise it makes no sense to call a direction of market just based on one chart.
And correct me if I'm wrong, but in the Elliott Wave theory, there's also the different seasons, right? There's winter, spring.
That's Kondratieff's.
Kondratieff. Kondratieff,
Yeah,
sorry.
yeah.
Actually, I mixed up because
yeah, sure.
we were actually talking about the Kondratieff.
Yeah.
So let's talk about this.
Yeah. So this is a very long-term perspective, and it's more to understand what kind of regime are we in on a generational basis. It's so are we in a regime that just after the Second World War, after the Bretton Woods, where we have all is anew, we have a fresh new start, the debt levels are low, and we just have growth is rising, we have new technologies, everything needs to be rebuilt. Is that the kind of setup? That is called the spring. I don't think that's where we're at right now. We are actually at the time where what is called the Kondratieff winter. There are 4 seasons in the Kondratieff setup, which is the spring, the summer, the autumn, and the winter, and they are all characterized by different setup, different characteristics of what you see in the economy. So you will see that in the spring, as I said, debt levels will have been restructured, and growth there will be new businesses starting up. And debt levels will typically be low, and you'll also probably seen that the inflation has been high at some point and is coming down. So there will be some things that will indicate that we have a spring season. Right now we have we are in the winter period. We've been that for some time. Actually, I think ever since the financial crisis, which was probably one of the first declines in the winter season. And what is that? That is actually where debt has become so much of a problem that it's starting to weigh down on the economy. So we have started, we've been, ever since the 90s actually, we've been seeing debt levels starting to move up, or actually since 71, you can say, since Nixon abandoned the gold standard, or the convertibility of gold, or to gold. You're actually seeing the debt has just been rising and going up, and it takes a long time. Again, we are out here on the big scale, right? So it's not just a short-term thing. But to understand that you are in a situation where the growth of the world is subdued because of the large debt that we have. We know it from ourselves. If we have a lot of debt in our house, we're probably not as prone to go out and buy a new car or do anything like that. So the higher the debt levels, the more we are seeing growth will be subdued. And that is the time then when central banks come up with this fantastic idea and thinking, well, we can do this, we can just print. Because what a lot of debt also does is that it puts a pressure on inflation in the longer time frame. So typically you'll see that in the winter, the inflation is very, very low. And that makes the bankers think we can just print. Mm-hmm. Because if we print, you can see inflation that's not going up. And who does not like a free lunch? Until the moment it's not free any longer. And that is what I think we're seeing, because the only end to this is that either they wake up and find out we can actually not solve a solvency problem with liquidity. or it's going to burst in their face, so to speak. And that is what the markets are there for. So in these time frames, you'll actually see some of the greatest bubble development. The last time we had a winter period was actually into the 1929 top. This is the next time. This is the time we have now. So it's not a good time. It's a time where there'll be a lot of fallouts. And then again, it's on a bigger scale, but it's just interesting to see how this actually plays out pretty much as according to the, and it also gives you an idea of which kind of, which kind of assets do you want to be in that time frame.
Exactly. And before we talk about the assets, I still would like to pick your brain on how long do you see this? Because you just mentioned like the 1920s and 30s. Those were the moments where like we saw like big downturns, but also war and social unrest. And before that, you even mentioned the 1860s or.
Yes, correct. 1860s, and also you can go back in time. It's more like if you look back in time and you see the cycles of that, you actually start to study it and you have a respect for that things may change and history doesn't repeat, but it rhymes, and you'll see that human nature is human nature and has been that for I don't know how many years. But you'll see that we are doing the same mistakes over and over and over. And Matthew was the other day, he actually stole my argument on talking about the Archenaux in France, because it was actually the same thing as he was correctly saying. Also, you saw into the French Revolution back then that they also, the idea of actually printing money was something they invented there. I mean, I'm not sure they gave them a Nobel Prize for it, but it was actually invented there. The Archenaux was something that was just thrown out there to make life easier, and they found out it's actually a nice free lunch we can get here. We get kind of an upturn and things are not so bad until the moment inflation turns up, and that is the problem. That's the problem every time. And then you've seen again also later in time. So you see these 80-year cycles where all of a sudden debt becomes a problem. It pushes lower growth, and then you'll see problems that arise from that. You'll see also people becoming more focused on nationalities and things like that as well. So you saw that also in the 80s, 60s, which was also, and you had a Great Depression also in the 80s, 70s in the US, which we don't talk so much about. Also in a time where you just had some new inventions coming out, and you were thinking, okay, now we have a lot of you had the railway coming out in the mid 80s, 1800s, and so it's things are repeating, and I think we're just in that period now again where the big wheel is turning, and some call it the fourth turning. This is the big wheel. This is the comparable to the 1940s or 30s, 40s, 1860s, and also even before that.
And it seems as well, and you tell me if you think that's the case, that the intensity also rises at every of those turns.
Yeah, so obviously it's when the big wheel is turning. Then we are turning. We are talking geopolitical, situations. We are talking the financial system, shaking, and people thinking that we had the financial crisis, so that's all done and dusted now. No, it's not. I think we have a financial crisis coming up again. I think we have a housing market crisis coming up. So we had the first half of that, and now we're going into the second half, and that's going to be worse. And obviously in a modern world like what we have today, and also with the size of the bubble we have today, because of the way we trade, the people's engagement in things, and obviously it's something that can have more widespread consequences, both economically and also societal. Societies.
And also the advent of the world wars were first premise of something that we could see on the global scale in terms of conflict. But now that we all connected financially with the internet and in all kinds of other ways, everything is actually pretty much homogeneous around the world. And the dollar is everywhere. And so if the dollar is sick and is rotting and broken, that affects pretty much any one of us. What are we looking then at in terms of the housing crisis? You just mentioned that. Let's go back to then your analysis of now, where are we in today? what are the indicators that are worrying you in terms of this recession that you actually mentioned before?
So again, in my business cycle model, we have a recession signal flashing, and we announced you see the deterioration of the real economy. And then if you go to Europe, it's not so difficult to see that. And that's normally also a sign that you'll normally see that the fallouts will be not in the US to begin with, and all money will be flowing into the US. But if you go to the US, I don't understand how the Fed can stand and Powell can stand just a few months ago and saying that the economy is just is very strong. Because the housing market in the US is not good. If you look at the housing market right now, you'll see that the number of existing home sales is down. It's in the gutter. You have the same level that you have that when the US economy or the US population were 80 million fewer than what we have at this point. So you would expect that a larger population would also see a larger, amount of home sales, and you see that at a time where the unemployment level is low. Normally, when we see a plunge in the housing existing home sales, you'll see that when unemployment is high. So at this point here, the housing market is giving us a sign of something. You also have the commercial residential, both commercial and residential, the market is not doing well. If you look at the mortgage applications also, it's down the gutter. Why are people not, applying for a new loan for a house? Because they can't afford it. And that's because of inflation, it's because of the interest rates. So if we look across that, then it's, I see it as the labor market is the only thing right now that's holding us back from a major fallout in the housing market. And already now we are looking at a housing market that is not doing too well. So I think we see the indicators of what we saw in the financial crisis also, that it's going to be a debt problem. It's going to be a problem with housing, which is normally where we see the worst recessions setting off. Also because it has implication for banks. People will not be able to pay their mortgages, and then they will have to sell their houses at on a fire sale. So I think we are seeing some of those indications now, and it's really just about when will we start to see the layoffs, because demand is not picking up as businesses want, and right now if for as long as the interest rates and rates are being kept so high, and we don't see a plunge there, well, people will be struggling.
And the inflation is picking up again. Why is it picking up, and what kind of inflation is that? Because if the demand is not picking up, where is inflation coming from?
But that's an excellent question, and that's actually where I probably differ from a lot of people or analysts, because if you look at leading indicators, coincident indicators, or lagging indicators, then inflation is actually a lagging indicator. Inflation is from what happened, months ago. So when Yellen, for instance, did not expect inflation to pick up at a time where they were stimulating into an economy that was where supply chains had broken down because of COVID, well, you don't get inflation like day one. There are certain indicators that was in the financial market that can shift really quick, but not inflation, because that goes through the whole supply system. So you'll have to see that your prices in the inventories and so on will have. And what you do first is you don't go out the first day and say, oh, we have such a large demand. Let's put raise prices. We will actually see, okay, we sell what we have in our inventories, and when the moment we start to see that we don't have the ability to actually get the new supplies and all, then it's time things will start to develop, but it takes time, and that is where why inflation comes later. So what you see right now is not as a consequence of what is happening right now. It's a consequence of what we saw earlier on. I'm not so afraid of the inflation level we have right now, because if you look at inflations just before the onset of recessions, going the last 3-4 recessions, you had actually much higher level in the inflation, and yet you got a very deflationary fallout. So right now I'm not worried of inflation. I do think though that inflation on a secular basis, on a long-term basis, have shifted. So we are at a very big bottom here, and we're going to see inflation moving up higher. This is the Volcker moment, where Volcker killed inflation in the early 80s. We've had that with Corona. That was our inverted Volcker moment. So we had we came out and we stimulated the shit out of it, so to be frank, in a situation where supply chains have broken down. That creates inflation. And even worse, it creates the expectation of inflation. And that is something that goes into the spine. when you have an expectation that inflation actually can be there, you are actually becoming more aware of it, and that by itself drives the crowd dynamics. So inflation is here now to stay, but it's not going to stay high for longer here, because I think you're going to see a plunge as the economy rolls over. And if I look at somewhere again in the multidimensional model, if you look at the commodity markets, oil looks like it's ready to plunge. So I see a plunge in oil, and that is going to bring inflation down.
And that is because of the worry of like a declining economical activity, or
that is a sign of declining economic activity. So when oil is starting to decline, of course people say there's a supply side to it as well. Of course there is. But when you see the big plunges, it's normally because there is a lack of demand, and demand is just disappearing. So I think we are in that moment here where if you just look, right now people are afraid because of what we see in the markets, because we have a correction in the Nasdaq and the S&P, and a strong correction in the crypto market. But that's not the same as saying things is developing right now and right here. I still think that there is a little time for that, and that means also that the inflationary decline that we could see can be 6 months from now or later, because again it's a lagging indicator. So we need to wait and see what comes, how fast the labor market will start to deteriorate. That's the moment when I think people should start to be worried about positioning in the market as well, and start thinking of how to actually take care of their whatever kind of risk on assets they have.
So then if we look at the housing market, I myself, also, if I look at the affordability that's given to me, even though I'm pretty good, and I look at the numbers about just in inflation adjusted terms, like my salary is not, or like the salary of our generation, of people who are usually below 35, is at all-time low in terms of affordability worldwide. So we're a generation that's been actually feeling now the consequences of this huge debt burden that inflated away our purchasing power. And housing is the most important, you might argue, as any type of basis for family. Now the question to you would be, is it a good moment then to buy? Is it maybe a good moment to sell? How are we looking at the housing market in terms of...
So obviously if we run into a recession at some point here, which I think we will, not in a too...
And time frame wise would be...
I think we're starting to see the fallouts. If you look at the indicators are flashing now, also more short term. We still need to see the labor market. I'll not call it before we see the labor market deterioration on the initial claims, and also especially in the yields market. Just to be very strict on that. So I'll not call it right here, but I'll say that we have all the structural damage to the economy that we need in order to see that coming. So again, it's an expectation and the sequencing of things. So that I expect to happen. And then you'll probably also expect that, or I will expect that you will see yields coming down, you'll see rates coming down, because it has to. That's the only way the economy will heal itself. It's like when things are starting to unfold badly in the economy, in the labor market, and the housing market, well, the only way to heal that is by yields moving lower. Why? Because you'll see that the demand for loans will be declining. So it's simply a supply and demand question again. The banks want to borrow, the banks and financial institutions, they want to lend money out. That's the way that's how they live also, and then they will the price on money will fall, and then at some point you'll start to see the healing process in the economy. So everybody's focusing on the Fed sitting and doing that. It's actually the market yields that is doing that for us. So we will see that, and that's what the Fed is waiting for. Also, that deterioration in the demand actually falling to lows there. But you're already there, as you said, right? And that's why we should also see the yields coming down, and that's where they have been stubbornly high, because inflation has been high. And I think it comes back to what I said earlier with the expectation of inflation, which is actually a more serious thing, and will also in the longer time frame be developing actually be moving up. So to the question whether you should be focusing on housing now, I think again, if you have a 10-year perspective, well, it'll be a great time. But will it be if you look into a two-year time frame? I'm not so sure, because I think you can have a situation where you'll actually see a pullback in the housing market also, because again, if people start to lose their jobs, unfortunately, then you will see that they will have to sell their homes, and there is an oversupply right now of homes in the US, and we see that, as I said before, there's already a standstill in the market. So we are not far off a larger decline in market prices in the US and rest of the world as well. So I would probably not look into right now, but there will be a time where it will be a good thing to do when the deflationary part of the recession that I see is developing. Then at some point, if you can afford it, well, then probably there's a good time to buy, because when you start to see the Fed and central banks trying to inflate this again, and they will be successful. If there's one thing they can do, they can inflate things that, they will inflate things. Then you'll probably also see inflation, and inflation is not bad for housing in the longer time frame.
Mm-hmm. So now you would say the next 2-3 years is actually like a good moment maybe to sell, because it's marks like a kind of a top in the cycle, and then after that the buying spree, or?
Yeah, I mean, selling right now can also be a problem. Again, if you look at just at the U.S. housing market, then you can see that the existing home sales is down so much, so there's not a lot of demand there. So I'm not sure you're getting the right price for it. Does that mean it cannot fall in price because there will be even less demand? Well, it can happen. So I'm not sure it's a good time to sell. If you are looking into getting out of your house, it's probably better now than it will be in a year from now, or a year, 2 years even from now. But at some point, again, things will start to pick up again. We will see a recession. It would not be, even though I think it can be pretty devastating, and it will probably both have a deflationary part and a stagflationary part. Well, things will pick up again at some point. And I think we're going to see that the only thing that can be done from the central banker's side by the end of this will be a reaction to first go in with money or with stimulus. That's what probably most people out there will be thinking when I say we'll have a deflationary bust and things will start. They will say Fed will not allow it. But the thing is, yes, they will be coming in with stimulus, but as we can see also is that inflation can pick up. And if inflation picks up, the Fed policies will actually become impotent. I mean, if you start to stimulate into an economy where inflation moves up, then you get more inflation. So that is the problem for the Fed at some point. And that's why I'm saying also the Fed's role here for the last 17 years has been, godlike. If you ask, the ordinary person, and we are sitting every FOMC and waiting for the wise words coming out of the mouth of Powell. I think we are overdoing it with that. And I think that we will see a world where the central bankers will not have so much power, because simply it will be taken out of their hands the moment inflation picks up. Then what can you can stimulate your way out of that. And if you don't, I mean, you need to do something about a potential stagflationary development. That is not in the hands necessarily of the Fed.
Mm. And also, just in general, I mean, it's quite obvious that keeping interest rates high is not even doable because of the just a tremendous amount of debt. The interest rate are on the debt that the U.S. needs to serve alone is insane. We just talked about it earlier. Right, it's 9 trillion this year, and to just servicing the debt.
Yeah.
So that will also not be doable. In terms of assets, then how are you positioning yourself in this type of setup?
Well, I think it's it's going to be difficult to position yourself in. How do I? I can tell about that, but I think it's going to be very, very difficult, because I think it will be a lot of whipsaw kind of feeling in the markets. You'll see that at a point here now that for until just a few weeks ago, markets are moving up, cryptos, or at least Bitcoin was moving up, and now we sit here, 3-4 weeks later, and crypto has crashed almost, had a very bad decline, and you see Bitcoin also coming down rather strongly, which is causing some fear. The equity markets are doing quite okay still. They have corrected, but I don't think it's the big thing. So I still think there is short-term a move up here, but and a strong move. And I actually think that's when the moment when the Fed will start to be some indications that liquidity will be added to the market, because there is a starvation of liquidity in the market at the moment, as I see.
And where do you see that? Because how do you base that assumption?
So, I base it on that, first of all, again, my model saying that I think there's a next move up. I base it on that, again, the economy has not rolled over to the degree that I think we need to see before we should see a fallout of that. And also in the final end of all bull markets, you will see that it's the Fed actually driving that last push. And this time around, I don't think it will be different, because they will see that the market will be starving. And by the end of it, if there's two things that the Fed, of course, is afraid of, it's inflation and deflation. But by the end of the day, they'll pick inflation every day, any day. And also, if you go back in 2007, you will actually see that the Fed was cutting rates when inflation were at higher levels than it is today. That's not, you can just go back and look in 2007. So the Fed is looking for the weaknesses in the economy. I think they are late with the tools that they're using, but they will be looking at for the weaknesses, and the weaknesses are coming. And especially if it comes to the housing market, I mean, I think even the Fed will understand that a situation like what we had in 2008, it's not something they want to see emerging again, even though I think it will. But they will try to prevent it. And that moment when, whether it's the announcement of QT ending, or whether it's going to be further rate cuts than what they've talked about at this point, or it's something with the repo market or whatever it's going to happen there. I mean, it's we have a lot of ways. They have a lot of ways of actually being able to start introducing or inducing liquidity to the system. I think that will drive the final hooray in the market. Everybody will think, okay, the Fed got our back. And that's the moment when we have that big move up that you'll see the markets really topping out. So for now, I'm risk on, even though what we see in the market, I think
you're buying the dip.
Yeah, at this point here, yes. But I think there will then be a time after that when the deflation will start to develop, and we are actually seeing the signs of that. So if you looked at it this morning, actually, you're looking at the SPX versus the TLT ratio, looking at risk on versus risk off, and just take a ratio of that. It's a pretty simple thing. And I think that we potentially have seen a major top in that. Doesn't mean that you're going to see a fallout immediately, but it means that you're starting to see money managers are starting to put their money into bonds instead of into risk assets and taking some chips off the table. And that is a good sign, not an immediate sign of a crash, but a good sign that things may start to develop in a more bearish direction. So I would say that there will be that, and that's where bonds can do well, and I think it will. They will. I think yields are coming down. The short-term yields will come down strongly, and I think, and then I think that will go on for some time. So if you look into the next year, I'd probably say bonds will be good after this final spike in the markets, and if you then look further ahead, it's a completely different scenario, because I think when the Fed eventually realizes that it has to come in again with the guns blazing, not just cutting rates, but we're talking about a September 2008 kind of thing. There will probably be a black swan that I expect could develop at some point, because we are now in the environment where black swan could arise, and we could see it 3 months from now, 6 months from now. At some point, you're going to see something like that. And I think that is the moment where the Fed will come in with everything, not allowing the crash, as people would say, and that will then create a completely different scenario. That's where I think the start of a stagflationary period can begin.
And so you haven't seen the top of the S&P then in that sense either. That
at this point, no, I don't think
it
so.
will also follow what you also describe as the Bitcoin or crypto boom. And if you look at now, zoom in a bit on Bitcoin and crypto, Bitcoin has had like its dominance quite strongly in the past months. And when we compare it to previous cycles, there's usually a moment where the dominance decreases and makes space for altcoins and the rest of the cryptocurrency market. But for this cycle, and correct me if I'm wrong, it's been pretty only Bitcoin focused. If you invested in Bitcoin at the beginning of the cycle, slash most of the other cryptocurrencies, some did well, but most didn't, then you actually lost money. And in the past cycles, I've been doing two bull runs since 2016. I gotta say, this looks a bit different. Do you have any perspective on why is that? Is that because of institutional adoption? Is it because of the ETFs? Like, what is or just people just realizing that Bitcoin is actually the most sound investment decision to do in crypto?
I think maybe it's because we are too quick on actually evaluating on what this cycle will look like. So it's always difficult when you're in a path somewhere and say, what will the whole journey look like? So I'm not so sure that we have seen the last of the alts rally here. And when you look at the technical setup for the Bitcoin dominance that you were talking about, yes, it has been spiking, but you're actually seeing again a deterioration in the strength of it. And I think we're standing in front of a large decline in the Bitcoin dominance. Why would we see that? We'd probably see it because the altcoins is going to start outperforming Bitcoin. Why would we see that? Potentially because we're going to see liquidity coming into the system. And again, then you can say, why would we see liquidity? Well, potentially because the Fed was starting to reduce it. And again, when the Fed starts to do that, that's not the moment we see the top in the business cycle. They are not that stupid. I mean, they trust. They start trying to save the economy before it actually falls over the cliff. They see the signs, and then they'll start to do whatever they can. And I just think that the moment we start to hear any of that, it will be the moment where you see this extreme rally coming. Because again, the feeling, the sentiment will then be the opposite of what we have right now. Oh, the Fed will not cut rates. They will just keep being hawkish. I think that's going to shift to the Fed got our back, and they'll do whatever it takes, because that's how sentiment runs. In that, I think that leaves the time for, and we have to remember that real altcoins rallies, they don't last for years and years. They last for, it can be 8 weeks, it can be even 5 weeks. I've seen, if you go back in time and look, the real strong rallies in altcoins. So I don't think you've seen that yet. And I don't think you've seen the top in Bitcoin. I mean, it's controversial to sit here and say, I think it was 80,000 when we started this interview here, but after some strong declines. But I think it's going to bounce really, really hard, and you're going to see a new top to it. And that is again based on that there's no one way. There's nothing when it comes to the financial world just moves in one direction. You will always see that there are bounces to things, and obviously the Fed is going to react to what we're seeing here. Mm-hmm. I mean, inflation, yes, but as I said, they have been cutting rates before also when inflation was high. They need to, because when they start to see the fallouts, and especially the fallouts in the housing sector, well, then it will have to do something about it, and even more so if they also see it in the labor market. So the liquidity injection, the one that will actually be defining of the top, that will helps propel us into that top. That is what I see as the blow-off top. But then it's they will not be able to, because again, you cannot solve a solvency problem with liquidity, and I think that's what we're going to see once more.
A lot of people also like to know or ask the question, so how do you call the top, or what are the indicators or the things that will, in your personal case, show you that we reach the top?
So there is a way of looking at. First of all, there are some levels when we look at it technically, Elliott Wave wives, Fibonacci wives that needs to be reached, as I see it. Secondly, there will be something about the deterioration in the strength of the market. So even though you've seen the market been moving up over the last, since mid 2024 here, so it's actually been doing that under a decreasing strength. You can look at the momentum of it. You can see that the highs in the momentum is becoming lower and lower, and that is an indication that a trend reversal is coming. And it's a very big pattern. It doesn't mean the pattern is over and done by now. So, but it means that it's coming. You had that also into the decline in 21, 22. You saw that actually you had the divergence there as well. You had it into the financial crisis. You had it so many times before. So I think that is one way of doing it. It's also looking at candle analysis down on the individual candles. It's about doing the cross indices analysis, also looking at where are the indices that you're doing. I've said for a long time I called the top in the Nikkei in July. I stand by that, and it seems to be the top. I think we're actually seeing some negative development today that is just, suggesting that the Nikkei could start a very big decline from here. So there are many ways of looking at it, but it's mainly to see that the deterioration in the real economy, in the labor market, and then par that up with the deterioration in the momentum, the strength of the stock market. And I just don't think we are there yet. I can be proven wrong, but I just don't think we're there yet. And I think we will see one more hooray because of liquidity going into that top. And then I think also people are way too negative right now. So with the kind of fear you see, especially in the crypto market, at a time where don't see this is normally also an indicator of something different, something coming that will send us in the opposite direction when it comes to sentiment before we see the top.
And now just to finally round off this conversation, we've talked a lot about gold the past days, but I would just want to have that's my last question, your perspective on gold for the next years and why it's so convicted in terms of your conviction. You have a strong conviction about it.
Absolutely. I mean, people probably know me that say, oh, but you've been so bearish, you're calling for the decline. And yes, correct, because I saw for the last many years that we would have seen a move in gold like what we see in silver and in platinum and and also in the gold miners. I mean, gold miners have not, even though it's the very foundation of their businesses is gold, and gold has been rising. You haven't seen that for the miners, probably because of the cost of the miners as well. But normally you should see those, that also develop. Also, if you look historically, you will see that gold has not been rising as fast as you would see it when you really have the strong bull market. Even though it's been good and fast, and I think it's 70% over the last year and a half or something like that, right? It's been quite good. And I can say I'm wrong, but I still think into the deflationary phase of a recession, you may not want to hold gold. And I think gold is maybe front running some of these things. And that can sometimes, create a larger pullback. So I think you're going to see a larger pullback in gold. And but that said, I think there will be a time where the problem will be for people that are only thinking bonds or stocks, where my ratio in terms of my portfolio will find it very, very hot. There'll be a very tough time, and we actually saw that in 22 when we had 9 months of where we saw both bonds and equities actually declining, and that was not a stagflationary period, but it was it rhymed to a stagflationary period. I think we're going to see stagflation at some point when this whole thing starts off, not immediately, but later down the road. And at that point, you don't want to hold stocks, you don't want to hold bonds. You want to hold gold and you want to hold commodities. Mm-hmm. And I think that time will come. So in the larger perspective of things, I would say with the extremity of this bubble that we have, with we are at the final end, we are at the Supercycle end here, with where we have been going in with liquidity to try to solve the solvency problems for so many years, and we've done it for 17 years. It's just creating a situation where the whole financial system needs to reset. And that is coming back to the Kondratieff setup there. That is actually what it suggests also. We are at that end. What is it that you need to be into, or what your assets do you need to hold in a reset like that? That's gold. And you probably want to hold it physically. Physically gold, you want to hold it in places where you can say, it's mine, I can go touch it. And I have it, because it's a thing that it can't be taken away from you then. It's you hold on to it, and you'll see that when the whole reflation will be going on, and the shift of things and the unwinding of the debt bubble, you'll see that people who will be holding gold will be standing very strong. So my projections into the 2030s, and I did some based on what we saw into 1980 and also in the bull run we saw from 1999 to basically to today, but really also to 2011. I could see gold going in. Well, I mean, people are talking about 10,000. I'm talking 15,000 easily, 20,000 also, and I could even see $30,000 for an ounce of gold going 10 years from now. Why? Because the balance sheet will go up. It'll just be exploding higher, and gold will be following that in a long time frame. So gold will be a fantastic asset, and you can do one thing. Go take a look at the chart of the SPX or the SP 500. In gold. That takes the dollar out of the equation, and you actually look at, do you want to be in risk asset like the SPX or gold? And right now we have a moment that looks a lot like what we had actually level-wise also, what we saw at the Nixon moment when he took gold, the convertibility of gold away, and you saw gold actually starting a fantastic rise from there. So I think you'll see a moment here where gold, in terms of being a better asset than the SP 500, is very, very close. And there'll be a waterfall moment. I see it in that ratio, which means that gold will do fantastic in relation to SPX. But does that mean you cannot have a decline in the gold as well? Well, you can have a decline in gold and SPX, and then we actually see the ratio will still be declining. That's that. So I think that we are coming to a close here with or to a moment where gold will be outperforming for many years, if you look at gold versus the SPX.
Beautiful. On that note, really thanks a lot, Henrik. It's been a pleasure to meet you. It's been a pleasure to spend a few days with you, share those moments with you, with the others. It was really a real pleasure. And I hope we'll see each other again soon. And
Thank you very much for having me here. It's been a fantastic, also fantastic meeting you and meeting the team here. It's a great team and these surroundings. So what's not to like? And also for having the opportunity to actually speak out and talk the whole story instead of just the more cut off version of it. So thank you to you as well.
Thank you. And to the viewers, if you've liked this video, just give it a like, subscribe, and I'll see you in the next episode of the Macroscopic Podcast.